Okay.
All right. Well, Ira Harris has just joined us for a chat. Okay, guys, take it away.
Hello.
Hey, Ira.
I put in my British accent because somehow when people in TV land think that if you talk with a British accent, you must be brighter than you are. So I'll join that crowd. Sorry for any Brits I'm offending, but it's okay. All right, let's go. What's going on? Where are we going?
Well, what's amazing is it's just this recent pop in gold.
Hey, how about my call to you this morning about that I was buying the gold and selling the April calls. The vol was 52% this morning.
It's crazy.
It is nuts. It is true. It is truly nuts.
Yeah, and I was looking at the gold silver spread.
Oh God! Yeah, I'm gonna tell you what. There were people who called me, after Carter Worth, I guess, did a big technical thing on gold silver a week ago. That it was up at par, 100 to 1, which was all-time high. And they were asking me about. They called me asking me about it. I go, look, silver will find its place, but it's going to be when somebody actually has to push at it to bring it into the monetary scenario like gold. Right now, the algorithms and traders have silver pegged as an industrial metal, and it trades much more in line with silver, platinum, which is highly unusual, because usually platinum trades more as a precious metal, but the correlation, and we've talked about this. This is not new. This is why they lag. They have them as industrial, as much industrial metals as precious metals. That too will change. When? I don't know. But the fact, I think that the gold silver this morning got to 120. 120 is just incredible because the previous all-time high made in 1991 on the gold silver cross was like 98.5. So when we took that out, which we did about 8 or 9 trading days ago, this has really been. This is epic movements. We've never seen anything like this. And I'm so much of my work on the global macro basis is relative value, which is interesting because we're seeing very interesting things in the European debt markets, but we'll get to that. So let's go through the litany of questions first and see where that leads us. Okay, so
Go ahead.
who wants to moderate?
Well, you have the list, so you can just go right down the list if you want.
Yeah, hold on. Let me get to that.
Or I can read them off. I've got them right in front of me if you want.
Yeah. All right. So let's go because I'm going to the. Let's go to the. Okay. Question 1. Trying to understand high yield. What do those Fed purchases mean? Right. Is that the first question we're doing?
That's the first question.
Okay. So let me put it like this. We don't know. And I can cover a few of these questions in that regard. We don't know. We really don't know because we don't know really what the Fed's going to be buying yet. And I know somebody asked a question and we go back, Kevin, so we're going to wrap a few of these in together. So who asked the question about the Kevin Warsh piece yesterday? It was a Kevin Warsh op-ed piece in the Wall Street Journal yesterday. Somebody asked about it. And I had an immediate comment to myself that I wrote down that after that, this is the second Kevin Warsh op-ed piece probably in the last 2 or 3 weeks. And after you read it, you go, you sure wish that he was the Fed chair at this time, because the piece is really takes you out of the traditional mode of the way that, and what I consider the Fed lockbox in the way that they think. And he really takes you outside the box, which is good. And, when Trump was getting ready to appoint a Fed chair, there were rumors, of course, that Larry Lindsey or Kevin Warsh were being the prime candidates. That he had actually thought about reappointing Yellen because he liked various aspects of her, probably because in his own way, he probably thought he could bully her a little bit better, but I would think he was totally wrong about that. I think it's easier beating on Powell. Powell just, when he started to move away and started raising rates, I shifted my opinion. I thought that was the right thing to do. When he was doing the the quantitative tightening along with it, I was very open and non-Santelli, saying that was, I thought, ill-advised. Do one or the other and see how it works before jumping to both. And then Druckenmiller came out with this. It was December of 18, criticizing him for using double shotgun rather than just going slowly. So that's not new criticism. Then he pivoted, and he totally, not that it matters, but I became very suspect of his leadership ability as he pivoted so quickly. Just my, for whatever it's worth, again, everybody has opinions, great. So, wow, gold's just jumping all over the place. Yeah, those calls I sold will probably get into the money today. But the piece was really good because it really was, trying to get the Fed to get out of its comfort zone and do things that it wouldn't do. So now let's get to the high yield. So we don't, and Morse talked about it. That's why I bring it up. Because again, something that I blogged about quite a bit over the last 4 weeks is Section 13, Part 3 of the Federal Reserve Act. And this is something that, Powell is very careful about getting to act upon, because I go back to Paul Volcker back during the Great Financial Crisis, that he criticized the Fed because he thought they were really pushing that way beyond its intention, and that they had to be careful because they were going to bring down the ire of certain political entities. And I think that's the point of looking at 13.3. Now, they cannot at this point really buy that type of paper, the high yield debt, because they're just prohibited. That's why you don't see them at least openly in the equity market. And I'm not a believer in the PPT, the plunge protection team, because I've always maintained if something like that, and this would go through like 4 or 5 presidential administrations already, that there would be people, conspiracies are always, they pique our interest because there's probably a modicum of truth, but you just can't contain those types of conspiracy theories. There's just too many people who know about them. And, this is a country where, somebody would have you on some reality show and you'd be, yeah, I'm part of the plunge protection team. And we just have never heard it. So I know people think it exists. I will need to be shown real data to reflect that before I become a ready believer in it. So that's just my opinion. But can they buy this stuff? Not as of yet. Will they get some legislative relief from Congress? Maybe. maybe, but at this point, I would call that very early, to tell you the truth. You know, it's just too early to go down that path. It would be a pretty aggressive step for them to take. Now, what will happen is that as everything goes to zero or close to zero, there will be those who start chasing yield again, no matter the pain they're enduring. Can you hear me? Hello?
Oh yeah, we can hear you.
Oh, yeah,
Sure.
we can hear you. We just have ourselves muted, so we're listening.
Okay, so everybody, you know, again, people don't really learn. So after X amount of time, they'll come back searching for high yield or, you know, a little extra. And, you know, it's one of the things that drives me crazy is how much risk people take chasing 30, 40, 50, 60 basis points. I'm amazed. And that's what's been going on. And that's who's really under duress here, because they're finding out that they took on a lot more risk for very little return. But, you know, the Fed has to wear that, because part of there's always a cause and effect. So when the Fed pushes rates around and it keeps them low, we know what the outcome was. It was, you know, a Hyman-Minsky moment, and where people just get complacent, and they start chasing things that they have no idea. And they get phone calls, because I know people who get these phone calls. People of substantial wealth. Oh, you know what? We've got these mezzanine loans. We've got these loans. You know what? And everybody goes chasing them. And I asked, I said, you understand what you bought? Well, no, my broker told me, you know, these are all, you know, high quality credits. And I go, no, you know what? You've been sold some paper that you better be very, very careful of, because this is going to cause you a lot of stress. And they're stressed now. You know, I get the, why didn't I listen phone calls? I said, you didn't listen because you're chasing exorbitant yields. I said, I'm advising, you know, for people to stay in 2-year, you know, notes or less. You know, it's been my mantra, and I'm not backing off from it. I think it's been the right place to be. And even my kids have called me and said, thanks, Dad, for having me buy the, you know, put some money into 1-year T-bills. Because you can, you know, and you know, 5, 6, 7 weeks ago, they locked up for a year at 1.5%. You know, I had other people tell me, oh, you're nuts. I go, yeah, well, you're buying 10-year for 1.9. Okay, yes, I know we've gone down to 30, but those have also gone, you know, basically to 25 basis points. So the movements have been commensurate. Yes, you got some capital gain. That's if you can get out of those 10 years. But I just don't believe in taking on a lot of risk, chasing very little yield. It's just my view, and it's one of the things, you know, because I think one of my great strengths in being a global macro analyst is that I understand the workings of the global debt markets. Very important. And people do some really stupid things. And then, of course, they're involved in these ETFs, which are passive, and you don't even know what's in there. You know, I make them equivalent to the same thing of subprime debt, right? Everybody got stuck in subprime debt. Why? Because it was rated AAA. And again, it was a low interest rate time when they first came on the scene, and people were chasing yield, and they bought all this crap. Because
Ira,
yeah.
1 second. I just want to point out to guys that 2,500 in the S&Ps, give or take, and the SPU bonds on the half days trying to put an ORH bar in. So just keep your eye on it. It's not a small thing.
This gold market has lost its friggin' mind. Okay.
Okay, go ahead. Sorry.
So, you know, so we have all these things that we have to, you know, take in. But subprime, don't forget, 85% of the debt that people were buying as mortgages were rated AAA. It was the 15% that blew everything up, supposedly. You know, that's using Wall Street numbers. So people make some critical mistakes chasing a little extra, not knowing the risk really involved. And when they blow up so big that, you know, you have no chance. Because don't forget, again, 85% of all that asset-backed securities, the mortgage-backed securities, commercial mortgage-backed, those were purportedly 85% of them quartering AAA. Well, you know, we found out about how that works. And, you know, I had my own view as to why that was done like that, what it was a response to. So, I mean, what's the Fed going to do here? The Fed is going to take a lot of things on their book, but they're going to have to get some legislative relief for it. And you see it this morning because they're involved in the, you know, the Reuters reported that they were involved in the commercial paper market, which is really a form of this, because when people can't move commercial paper, of course, what are they worried about? They're worried about the credit standing of the underlying corporations. And these are the top corporations in America. But I think that when Boeing drew down that their credit facility last week for $13 billion to make sure that they had cash, I think it really unnerved a lot of people because, you know, Boeing, if Boeing's not, you know, in most people's minds of AAA credit, yes, I know that things, you know, are certainly dynamic, but the fact that they had to do that forced a lot of others into the system to do it. So I don't know what the Fed is really going to do here with the high yield, but we'll have to wait for more. But they're in the mode where they're going to buy everything that they possibly can because they want to ensure the ultimate stability of the marketplace.
Well, we just got down to the 50 semi-annual bar in Boeing. I thought it could go to 50, but maybe they save it here.
You know what? It's unbelievable. I mean, I think, you know, as somebody called me yesterday and was screaming about Boeing because somebody has them invested in it, of course, and they can't get out. So you're going to get out now? You're not in preservation mode yet. You know, you're still in just watching it. And he said, I think about that one day that they were watching, what's that show that comes on with Wapner on CNBC?
Fast Monkey.
Fast Monkey. And they talked about that guy, Steve Weiss, talking about Boeing, you know what? Boeing was down to 350. And he was saying, and they were saying, well, what are you going to do with it? He said, it's going to 425. I'm not, you're crazy. So, you know, he says, I think, the guy was telling me, he says, I look at his face every day and go, and now I'm going to just smash it because he was so arrogant about it. But how can you get out? It's going to 4.25, you know.
Ira, do you think those guys ever opened up a spreadsheet to model a company that they have an opinion about?
I don't know what they do. So, you know, they're not my cup of tea. I don't watch, you know, I used to like Josh Brown, but he's been kind of arrogant for me too. You know, he's so certain about so many things, you know, and you know, Judd will back me up. I analyze a lot of many things, and people have heard me, but am I so certain about anything? Nothing. I put on trades, you know, here this morning. I was buying gold between 1470 and 1490 and selling the 16 even calls that expire in 9 days, the April calls. And I'm doing them yesterday. I was playing with them. I'll do this with the options at times when we're getting close to expirations. If I like the underlying, and I was doing it yesterday, and I could buy gold, the gold futures this morning, April, $30 lower than I was buying yesterday, and selling the calls 1 day less at the same price I was selling them yesterday because the volatility was over 50% this morning. So I was playing with that, and I took it off because am I so certain? No, there's nothing that I'm so certain about. I mean, I do my work, I do my analysis, and as you know, my key point is where can I define my risk? Because I'm in for low risk endeavors, as low as I possibly can. It's all about how much bang am I going to get, for the buck that I'm risking. And if I can do that right, and Pat, you've been privy to, especially when there's Fed meetings, now they're worthless. They mean nothing. All the data means nothing. People are sending me on the retail sales. Yeah, I'm concerned about February's retail sales. Yeah. Well, tell me, we've already gone down to 0 to 25. The Fed's been doing hundreds of billions on a daily basis. There's not an economic data point I'm concerned about right now. Not one. There's nothing that can move. Unemployment, sure, but what? So that's all I can say to you. I'm just not so cocksure, and I watch these people come out. And again, it's the art of sales. I'm not selling you. I'm trying to ferret out ideas with you. If I pretended to know everything, then and I can't. That's why, again, the purpose of coming into this room and getting these questions is to ferret out the better investment ideas. I certainly don't have the best investment ideas. I think I have some good ones at times, but let's analyze them and work them apart. And dealing with your questions is probably the best way to deal with it. You want to jump on to the next one? I hope that, it's again, the real answer is we don't know.
Yeah, well, that's going to continue. And it's a price action trade, guys. You saw how everybody got trapped this morning. Some of the guys in the room actually got long. We're coming up to a lot of levels, and, they could lock them limit up. What's the difference? But, if you're trading the names, make sure you're on top of the names, because if the futures stop trading, the names aren't going to stop, are they? No, they'll keep trading.
Yeah, that's a good point, Judd. And Terry Duffy was really good yesterday. And what I'm saying is not self-serving. It was just really good because he was able to, the media just tries to trap you with certain questions and the fact that, the markets stop trading. Well, I'm a believer that that's a good thing, by the way. And it's self-serving. That's self-serving on my part. Because again, Bill Shepard and a couple other guys back in the late 90s, we were the ones who really advocated for speed bumps. So, and I think those work well. And the fact that the ETFs don't have them presents a problem. And Kelly Evans was pushing at him, and I thought Terry handled that discussion exceedingly well. So things that go bump in the night. So I think the point you raised is a very, very good point.
All right. What were some of those other questions that? Well, there are a lot of questions about where people's money's safe. Some of the firms sweep their money into an SEC side every night from the futures side. The question is it really segregated money? And what do you have to do to protect yourself? So if somebody blows up, your money's actually there.
Judd, that to me is what I call penultimate question, because I've been fighting this battle well before Lehman, but I certainly after Lehman. And my attorney, Ricky, who's a securities attorney, every time I go to a new firm, I try to get them to, let me separate my futures trading from my stock trading, to be able to hold my stock purchases in my name. The way you used to, when they used to send you a certificate, you'd put in your safety deposit box. And when people died, people would find, hey, he owns this stock, or she owns this stock, and and you own the stock, and they would call you if they wanted, if because short sellers have to borrow the stock, so that's the stock lending business for those who are in hedge funds. So now it's not held in your name. That was the problem with Lehman, is because Lehman had hypothecated so much of their of customers' money, to lend those stocks because it's held in street name and used it as collateral. So the issue when Lehman blew up was the issue of all these people who didn't realize it became creditors of Lehman. It all got resolved, but it was still a serious issue. And a lot of people woke up to the fact about custodialness. Okay, to be a custodian, who's your custodian? And that's what we're talking about. So when we saw MF Global and the shenanigans of what's his name?
Corzine.
Yeah, Corzine.
John Corzine, whose name I tried to blot out like Heyman at Purim, because I, through a hedge fund I was invested in, I found out that I had money at MF Global. I'd already not liked MF Global because even prior to when they blew up, when they bought out something, they really did not treat a couple of friends of mine who worked at MF Global. They didn't treat them well, so they were on my bad list.
Yeah, you were in there at that meeting with Barry when he sold his company and bought bought his jet when we were trying to set up that arb. And he told us flat out to get the hell out of there.
Well, he made me stay at Revco for a month because I asked him. I said I want out. He said just stay a month. I said okay, I'll stay a month. Which we'll get to another issue. So make sure, and I keep my money, all my free cash. In fact, my collateral. So my futures account. Okay, that's my stock trading account. But even with my attorney, they will not hold your stocks in street name. Now, I guess for some really big players, they will because they want their business and they come to some type of agreement. But most stock, especially go figure it out when you own an ETF, right? That's always been an issue for me with the ETFs. Where is that stock? What am I entitled to? So these are very serious issues, and I'm sure we're going to see some. And I'm not being flip when I say what I'm going to say, okay? Understand this because this is something, you want to talk about a virus epidemic. 1929, when the stock market crashed, there were a lot of people jumping out of windows. And, we just don't hear about that, but yet the losses have to be great, and where are they? Because there's no question that there's huge losses. And I'm not talking about just Bridgewater. God knows how much they ultimately are going to lose here. And I just saw that Jimmy Simmons' firm has also had the worst month they've had in 12 years in February. So there's a lot, and don't forget, again, Wall Street is a herd mentality. Once somebody gets a sense of somebody has something that they're doing really well, everybody crowds into it, which is, how they crush all the margins. So where there's one, as Dennis Gartman was always fond to say, there's never just one cockroach when you turn the lights on. And that's true. So I'm expecting to hear some losses. So people are right to be concerned. And again, I keep as much money as FC Stone, Shepherd will allow me in treasury bills, because those are at least in my name. I buy a treasury bill in my name, which puts me higher up the ladder than most others. But it's always a concern. It's a concern of mine every day, even when markets are calm. So it's a very good question, and it's a time to dust off your agreements and make some calls about, hey, again, it's your money. Don't let anybody dissuade you from that. I can tell you a story right now about, people forget, when they manage your money, they begin to think it's their money. It's not their money. And then this is a story. It's not necessarily just like this, but it's always a warning about when you give your money to some fund manager or some account executive. You always understand that it's your money and you make the calls. You make the calls. Don't surrender it. So, as I wrote in my blog, it's been a month ago that I liquidated my retirement account, whole thing. And I knew that the guy who manages it at BMO, so I have some money at BMO. He says, "You're liquidating all?" I said, "Yeah, liquidate my entire retirement account." So 2 or 3 days later, my brother called me. Not my brother, the infectious disease doctor. My brother Max is a doctor, rheumatologist, and he said, "I'm uneasy here. What do you think?" I said, "Well, had you called me a couple days ago, so I told him what I did. He said, "Okay, I'm getting out." And it's funny because in December 1999, I had him over. We were having dinner, and his kids were there who were already in college, and he had retirement funds for them. And I told him, I said, "Sell out 50% of all your equity." He says, "No." He says, I talked to him. He called me. He said, "No, my advisor." I said, "I'm telling you, this is going to blow up. It's priced for Nirvana. There's no rational basis. Sell out 50%. That was right before the dot-com bubble bust. So he didn't do anything. And one of my nephews, he says, "Dad, why didn't you listen on Guyer? Why didn't you listen on?" He said, so now he calls me and he said, "What do you think?" And I told him what I had done. He said, "Okay, I'm going to sell my entire retirement account where he has the brunt of his money." I said, "Wait." So the next day is when we got that 4% rally. I'm giving you the timeline. So I didn't talk to him for about a week, and I sent him a text, and I go, "Did you execute?" Because I told him, I said, "Wait for that rally to sell." He said, "Yeah, I got out of everything." And he said, when I called my account, he wasn't there, so I had his underlings do it. And then the guy called him back, and he was pissed at him for not consulting with him first. Okay? And this was already when the market was down quite a bit. And I said, "You mean he didn't say, 'Wow, that was a really good decision. I wish we would have talked.'" But no, he was just upset with him. So I told him the other day, I said, "Call him back and see, He said, "Maybe he wants you to manage his money." But we all these people think that it's their freaking money.
Oh,
it's not.
It's the same thing. Angela got my wife to get out of the bulk of her stuff like a month and a half ago. And
yeah, I saw it.
They were pissed. They didn't want it. They didn't want her to, they wanted her in emerging markets. They wanted all this. Stay with the balanced approach. Are you guaranteeing the returns? Are you guaranteeing your balance? I mean, come on. Right.
That's exactly right. Hey, and that's all. And I'm not saying this. I'm just saying you're in that theme. It's your money. Always protect your money. Always. Because that's how I start. It's my money. And I don't want to hear from you about blah, 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 blah. You know what? No, I'm not there to enrich you. As I have a friend, Judd, who I've known, and he's one of the great gold analysts. He used to do gold stocks in the late 70s and early 80s. He's a nephew of a very famous gold trader who I know. And we email constantly all day long. He's a little angry at times, but he's removed himself from civilization and lives up in the Catskills around Woodstock. And we go back and forth all the time. And he can't be more explicit. Every letter ends with, what's his name? Who is the great trader on Wall Street? Jesse Livermore. And Jesse Livermore has a famous line, which is, and he ends every one of his emails with this, what Jesse Livermore said: "The customer's profits are on paper, and that's just where they will remain."
Yeah, where are the customers' yachts?
It was right. I mean, it's in there.
Where are the customers' yachts? Hey, Ira, a quote out of the book. All right.
Yep.
It's all still just speculation and human nature.
You know what? That's why I'm a behavioral economist. I was a behavioral economist before there were behavioral economists. You can't separate the psychology out. Listen, as we know, what are the two emotions that drive any market? Fear and greed. Those are human emotions. And it's just, as this room knows, believe me, I try to talk people out of at least take 50% off the table. And this was when, the S&Ps. Judd, what chart were we looking at that signified that there was a little warning sign there?
Well, I just had it up. It was the SPU bonds on the yearly.
Right. And I said, this one failing. So we had a signal. And I said, okay, if I'm wrong on that, again, it's trying to find the levels where we're comfortable making these decisions, making trades, even making investments for longer term. You'd want to find it, and that was the level, and it said, there's a little warning here. Okay, I understand you got to put money to work. It's a world where, ultra low interest rates, blah, 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 and that's what's going to be on everybody's radar screens, right? We know it. There's no getting around it.
Ira, the fundamental problem, I believe, is that people are so indebted, they don't save enough, so they stay in the market because they're afraid that they're going to miss out on something.
Oh, listen, Pat, there is no question about it. None. It's 100% right. And this is what the Fed has brought us. This is what Mario Draghi, when you take rates down to an abominable level, you force people to make decisions that they would never be comfortable making. But that's what, I'm not making this up. Ben Bernanke, August of 2010 from Jackson Hole, in his speech when he was laying out what they were going to do with QE2, calling it the portfolio balance channel, in which he wanted you to take the money out of the bank and put it into more risky endeavors. That's what a portfolio balance channel means. And see, once they walked you down that line, they had to keep it going. And again, my sense of where this all really went off the track was when Bernanke caved in to the temper tantrum, caused when he was going to start shrinking or cutting back, not even shrinking, but cutting back on purchases in May of 2013, and the bond market broke, meaning the futures price and yields rose dramatically in response, and it caved immediately. And that set a very bad course because the market then, from that moment, said, well, we're controlling the Fed. Whatever actions we do in reaction to what they're putting out there, is they were in control of the Fed, and the Fed had to respond to them. Okay, Jay Powell, I give him credit, because in 2018, he was moving away from that and said, hey, it's time, we got to get away from this. But he too caved. Once the market put so much pressure on him, dropping 22% in the last quarter of 2018, boom, the Powell pivot. And that's because he went too extreme. But the market controlled him. But you are not, and we knew this 4 or 5 weeks ago, that this was different because interest rates were doing this, and this, and they were not getting the market response. Yeah, we'd have a one-day rally of 3%, 4%, but it couldn't sustain itself, and we weren't going back to those highs, even with all the discussion and about what Fed maneuvers were going to do. And then the day they cut 50 basis points, and we know what that action was. Okay, so you had a pretty good sense of what was coming. That this is not. And all the players who were playing for the Fed to always bail this out. Nobody more so than the risk parity players and the vol sellers. Because vol selling is now an investment strategy, as it has been. Go back and read Bill Gross in 2016, 2017. It was a strategy. He said, you'd be a fool not to do this. Okay.
Well,
You know what?
take a look at this semi-annual and the SPU bond just for these guys that just came in. I mean, first of all, when I talked to Adam was last week on Tuesday, we had given back 5 years worth of work in the spread, and everybody was still believing that this was a break to buy in the S&Ps. That was 500. Where was that? The S&Ps were at 2,100.
Yeah.
Now we've just completed a 50% retracement since the 2007-8 crash. 50%.
Yeah.
That's the
Yeah,
enormous break.
Right. You know, Judd, I was looking at this. That's okay. And that's worth discussing, and it should be on people's radar screen because now, you know, the markets are going to be wild and volatile now for quite some time. It's just the way it is because you're forcing a change in strategies. So where the algorithms were totally dominating this, and I said what were we? We were devoid of fundamentals, and it's been very hard for traders like myself. Hey, I told you in November I had the worst month I had in 30 years. But hopefully I'm going to have the best month that I've had in 35 years this month. I got stung a little bit in the gold the other night, but it's been, you know, good trade because why? The fundamentals are going to return to the market and not be dominated by the algorithms, and the algorithms will have to be rewritten to try to get in sync with the fundamentals moving more to the forefront. But you look at some of the greatest traders in the world, the Tudors, the Caxtons, you know, the Coveners, the Druckenmillers, they've all been on their back, on their heels because, yes, they're momentum driven, but they're fundamental. They do a lot of fundamental viewpoints and then they'll put on positions to mirror what their thoughts is. Well, they've been run over like everybody else over the last 5, 6 years, 7 years, 8 years, because you've had the rise, and with the Fed in play and the market having that complacency, there were things that were in motion. And listen, nothing more so than the risk parity players. And those numbers of investments are enormous. We just don't know how it's all going to fall off. But you're going to see things open up. And look at the gold this morning. Gold is a classic example. This morning's action, I mean, we've had a $90 range in the April gold. And that has a lot to do because some of the fundamental players are getting back involved. Because as I said to you yesterday, you know, I wasn't on with you, but Judd, you and I said, watch the gold yuan, the gold Swiss. These were getting to very interesting levels. In fact, the gold yuan got very close to the 200-day moving average, which is just mean reverting after all by the end of the time. But it did give us some location as to how to put on that trade. And when I looked at it this morning, when the gold was lower, that was one of the things that prompted me because I saw where certain things were at. I said, okay, I can deal with that. I looked at the gold yen, you know, and we had cascaded through the 200 moving average on some of these, but others held. And a lot of that is, again, markets just, it's not just a need to raise cash. There are other things at hand. When you have those massive money, the massive aggregation of money, and they start liquidating because they are absorbing losses and they just have to clear the books. Any trader, and people in this room should all be nodding their heads, even when you have good trades on and you do something stupid and lose money, you get out of the good stuff and you go, I just want to clear the decks and start over, right? Anybody not do that ever?
I do it all the time.
As much as I'd like to conquer my bad things, I'm guilty too. And I know many other, I've got emails coming in right now discussing exactly that. I gave up. I tossed, and these are from some pretty good traders, but the volatility in the gold today harmed some people because it was easy to buy it last night. And then you got caught on it again. And the interesting stuff in the European bond market is, I mean, that's more than interesting too. I find it quite fascinating. We're getting some, now the Bunds are up higher in the day, but the Europeans,
crazy.
yeah, and those spreads, and they're all blaming it on Lagarde, but we'll discuss that too. But okay, so we discussed under the accounts, never forget it's your money. And if you have any discomfort, get the hell out and go somewhere else. That's all. That's all I'm going to tell you. Never forget it's your money, and don't let anybody give you a song and dance. Any other questions?
Yeah,
we had some
just
more.
put up the Bund Italians, but go ahead and ask the questions.
Oh, sorry. Hello.
Yeah.
I've got a question. It's Matt.
Yeah.
All right. So one of the guys in my room had put this out there earlier, and I thought it was a good one. If the Saudis go for the jugular this time, can equities and crude diverge in terms of a counter trend rally?
Yes, probably after all this has been said and done, because you've inserted so much pain. And it's a question of how low is it going to go? And we're going to start to see the bankruptcies come out of the oil patch very soon. So I would start doing my work there and find out who's the most vulnerable, who carries the most debt. We've talked about this before. And you want to stay away from those who have way too much debt relative to cash and equity. So, excuse me, let me, it shouldn't ring again. I apologize.
Oh, I thought that was the Clorox man coming to your door with a case.
No. I'm telling you, I can't get, my wife and I make our own with rubbing alcohol and aloe.
Yeah. My daughter makes that.
You can't get it. Yeah, it's good. That's what we've been doing, because you can't. Yeah. So yes, there will, and they will divide. So, but Pax, I'm glad you asked that question, because right now I would tell you that the Fed policy is an absolute failure. And you guys should know me well enough. Why do I say that?
Because that wasn't rhetorical. Because of the certainly not because of the equity markets, right? But because of they didn't get the desired response in the yield curve, nor in the dollar.
In the dollar, right now is telling the Fed, you need to step up more. And again, if you're targeting where, and again, everything that they've announced is to try to target the areas of vulnerability, right?
Yes.
That's what this is all about. Well, the greatest area of vulnerability, and Santelli and I had a discussion yesterday, but I saw he got it out there this morning after the retail sales came out, and he was talking, and he talked about it, because he actually talked. What did he talk about? The CRB chart. He talked about the commodity charts being at 25-year lows. Well, the commodity charts being at 25-year lows, and it goes with the oil, because the Saudis and Russians say, hey, there's a lot of systemic vulnerability here. We're going to get response. And we're going to force this. So, again, if I was Mnuchin, I'd be back at the Russian ambassador today going, okay, we're going to remove the sanction, but we're only going to remove the sanctions if you agree to cut the oil. Because you know what? Oil prices, believe it or not, and I've maintained this for a long time, are part of the lubricant of the global financial system, because so much money. Mm-hmm. So when you have revenues declining so dramatically, when you have revenues declining so dramatically, can you guys hear me? Because I have to go get the Clorox man. You have those revenues declining. it's harming the system, and it's putting pressure on even more. As I've said, that's a deflation. You're on the threat of a potential deflationary situation because of that, and they know it. So they know that. They know the vulnerability of the system here. They know it. And as somebody had an article out over the weekend, the guy, it was a Russian guy talking about why Putin was doing this. I think it was in the financial, I forgot where it was. Okay? Yeah. So, that was, and that when you really look at what the Russians are receiving, and don't forget Russian oil companies, they get paid in dollars, but they convert them to rubles. So as the rubles depreciate, their losses are not nearly as severe as what's going on in the oil patch. Okay? I mean, think about that. That's the implication of the dollar as a reserve currency. And the Fed has to deal with this role. You cannot get away from it. Look what's going on in other places. Now, the Saudis have a problem, as the article points out, because they're pegged to the dollar. So they don't have that same situation. What the Russians do, so the impact for the Russians is less than for others. So that's also something to put in our equation. And that's why you guys know me well enough and you've been with me well. So you go right to it, the currency. The currency is a friggin' issue. And the Fed policy right now is failing because the dollar is not down. And if you look at it against the emerging market currencies, which is what they should be targeting, the dollar is screaming. The peso, all-time high. The dollar peso made all-time highs. And in Mexico, yeah, they've got some cases of the virus, but they also have 7, or maybe they're down to 6.5% on overnight money. Yes, oil revenues are down. They're going to have some stress there. But other currencies are also good. The Canadian dollar at 141. Seriously? The Australian dollar under 60 or at 60 cents. Seriously? But this is a reaction. So you got to pay attention, and the Fed ought to be paying attention. And why they are not targeting emerging market currencies it just boggles my mind. Truly, it boggles my mind.
Yeah,
I would right now. I would right now call their policy a failure because it's not relinquishing that pressure on the global system. Oh, by the way, gold silver is now trading 122. 122 ounces of silver to an ounce of gold. It's truly, here, let's, just for kicks, let's see what that, the long-term moving average on that is. I think it's around 55, but I could be wrong. Let's see. Oh, 65 is if I use the 200-month moving average, if I go longer, but it's 65 ounces silver, an ounce of gold. We're up at 122. Okay. Let's see what the commodity index is doing today. Oh, I'm on the Bloomberg BCOM. Let's see, the previous low on this average was made in February of 99 at 74. And we're at 62 right now. And that's with gold at 1550 for the most part. So a lot of things, I would be adjusting my, meaning the Fed. Right now, they really have to be concerned that this dollar is not breaking. Yes, I know other central banks have cut. You know, the New Zealand cut 75 basis points, Canada cut 50 basis points, the Bank of England cut 50 basis. Okay, but these are fairly dramatic moves. And now, are you going to get the dollar on the dollar index through? Hold on. We're up at 99.58 on the spot.
Par 30. Plaza Accord
I'm
fib.
sorry?
Par 30 is a Plaza Accord fib.
Okay. So, you know, but it's really worth looking at. These are very important issues going forward. God. The decimation is across the board is really, again, but that's why you're going to wind up with what I really argue is the demand shock. You have to. And when people see their statements now that are coming in the mail, and they see how much money they lost in their 401ks and every other, there's going to be real fear because it's not getting better. People watch, it's a buy the dip. I don't hear anybody talking about buying the dip. Because to me, if you like Boeing at 375, you better damn well be buying it every day this week. I'm going to test. I'm sorry.
Oh, I was thinking about when you were talking about the Bloomberg Commodity Index, and I was thinking about a conversation I had yesterday with the cattle rancher from East Colorado, who's I met at Credelli's golf outing last week. Was talking about
Credelli had a golf outing?
Yes, he did.
What am I? Nothing.
I thought you were going. I wish you were going. Oh, believe me, I wish you were there. Anyway,
They were all looking at a 2-second chart with a half-a-second trigger.
Oh, man alive.
I
got so aggravated I had to keep my mouth shut. No, it wasn't Anthony. It was the other guys. Me and Anthony had a great time. Anyway, we were talking about yesterday the price of cattle and how so many farmers are going to wind up just declaring bankruptcy because of the incredible drop in commodities. For cattle, for hogs, thinking about crude being underneath $30 a barrel, Brent and crude, the spread flattening there, the crack spread, I think going negative, or at least it was earlier, was at zero. These things terrify me, and we don't, like you were saying earlier, we have no idea what the fallout's going to be yet, who's in trouble, who's not in trouble, what banks are in trouble, who's going to need a bailout? What are the moral hazards that are lying around here that that have not changed and continue to pick up since 2008? I remember a line that you said a while back, and this is something that's stuck in my mind. With quantitative easing hides a lot of the cracks that are in the system, a lot of the blemishes, of systemic risk, all kinds of things. So now without QE until, of course, until Zoltan's article in Poser's article or his statement in December, when the Fed started to bail out the repo system, and I don't pretend to even have any idea of how that what the true plumbing and how that works is, but we've talked a lot about it with you, and leading all the way up until today, seems to me like there's got to be some major players that are going to be in trouble that are going to affect a lot of lives.
There's no question. In fact, I'm glad you brought that up because there was an article yesterday in the FT in Alphaville why FX swap lines are the most important Fed action thus far. Okay, it's written by Claire Jones and Isabella Kaminska, and they end. So I'm bringing this up because they talk about Poser, and they cite, we've referred to a remarkably prescient note by Credit Suisse's Zoltan Poser, and I cited him because he's the best plumber of the financial system who's out there, and he writes, and it's available. And he writes this, okay, and this is going to take us down some very interesting roads. What I'm going to read, and this is from Poser's piece written for Credit Suisse clients on March 3rd. once the People's Bank of China, the BPOC, exhausts its dollar liquidity in cash markets like the FX swap market, it will next tap its treasury portfolio and will either repo or sell those treasuries through dealers in New York to raise more dollars to lend to local banks. Okay?
Mm-hmm.
So that's what he was talking about. And I've been beating the drums at this for a month now, that you have to get these swap lines to the emerging market banks. You have to get these in place and get them going. You have to. Otherwise, you are going to come up short. And again, I'm not guessing at this. I see it right now with what the Fed has done. End of story. The Fed, because of the dollar doing what the dollar is doing, they're on the wrong side of this right now. They're not doing enough. They're not doing enough. Or there's a lot of liquidity, but they have to target where it needs to go. Because right now people are, it's kind of freezing up. Nobody's really willing to lend to some of these more questionable borrowers, and they're viewing the emerging market corporations. There's like 11 trillion, I believe, in dollar-denominated debt in the emerging market financial system, supporting corporations, small businesses. There's just a lot of dollars to wash. And as Pax, as you talked about on the oil, as oil prices go down, sovereign wealth funds are making less money. There's less money washing through the system when it needs it. The Fed needs to target the emerging market central banks. Sorry, and I don't know what you're going to take for collateral, but I'll go back to 1995 when the United States bailed out Mexico, with Summers, Rubin, and Greenspan. That was actually well done, because what they did is they collateralized that loan from the U.S. to Mexico with Mexican oil. And it was amazing how fast that loan was paid back. So there are ways to do this stuff. You got to get creative, but you have to get money into the emerging markets. And all I do is have to look at a commodity chart. A commodity index, whether it's CRB or Bloomberg, to know that. And Posar is on top of this. And believe me, he is the best plumber out there as to understanding where the system gets clogged up. The Fed needs to get targeted here to where the money needs to be going. They announced it to the banks they already had, that they were who they already had swap lines with. Yes. So when I saw that, on Sunday night, I got a little excited, and I said, oh, and then when I read that it was just to the same banks, that was ridiculous. Now they're hoping that those banks will push the money there, but I wouldn't count on it. Europe has some of its own funding issues that they're trying to overcome. So you got to be aware. You have to know what's going on around you. And again, I say, excuse me, the Fed has erred here, because until I see some relenting. Last night, it was interesting. Look at the range on the peso for the day. So the Mexican central bank, I don't know this, but they must have been in last night, because the peso was 11 handles higher last night. Oh, that's when the S&Ps were locked in, and so somebody was buying some pesos. We're also going to keep our eyes closely on the euro-yen here, because this is an interesting cross. Right now it's under pressure because they're perceiving that there's more problems in Europe, of course, than there is in Japan at this moment in time, as Europe tries to get this under control, and with how bad Italy's handled it. Now Germany is having some outbreaks. So there is pressure. So the euro is dropped dramatically. But this is another point. The Fed thinks that they've thrown a lot at the system, but they're evidently still in some issues with dollar funding. Pay attention to it. But Judd, do some work on that euro yen. I think it's
I just threw up the quarterly, Ira. And what's interesting is it's come down to the basically close to the 2019 low. and got the ORL
Okay.
stops from last year, or the
Yeah.
or the ORL stops from last quarter. So the point of control is going to be 117.
Yeah, you know, so a lot of things to look at, but right now I would call the Fed lacking. It's lacking because it's not having the impact where it ought to have the impact. And look at, yeah, the equity market is now the S&Ps are up on the day fairly substantially, and I'm still looking. The peso is still down, almost on its lows. The ruble down. So now the disconnect is even more because you're just not getting that impact into the global system, and that is what is critical.
Yeah, we were looking at the long-term charts in Russell. I mean, Angelo got out right on the stone cold low of that thing, and it couldn't have been more of a classic trade on the decade fibs. And if it gets back to 1200, that's where you look at it again.
Okay. What else were we talking? I had something else I was going to bring up. And I should have made it up. Oh, so on that China deal. Okay, this is the last thing we're going to talk about. So let's say that Pozar is right on the China deal. Okay. Now, if I'm China, okay, and you know I like to run these little games that we play. If I'm China, because now the IMF is talking about getting into this and printing SDRs, but of course they have to do it with the okay of their membership, but adding to the liquidity pile. What's her name? Georgina, who I like, was, talking about putting $1 trillion into the system, which would help alleviate the emerging markets because they'd be able to target it better, but it still shouldn't relieve the pressure from the U.S. But if I ran the People's Bank of China today, I would sell not swap them, but as Pozar said, I would sell those treasuries, because I own all those treasuries. I would sell a lot of those treasuries to the Fed because I know they're in, and I'm going to get really high value prices relative to, if I hold on to 10-year treasuries, it has to be a bad investment, unless you're going to tell me that treasury yields are going to remain at 60 basis points for the next 10 years. But if not, China should sell them. And I would offer to do a swap. I'll back a truck up to Fort Knox, and you can have your treasuries and I'll take your gold. Or I'll go to the IMF. Of course, they can't do it because under the rules of the IMF, it's the member countries who really control the gold. The IMF can sell it, but they can only do it with the okay of the membership. But if I was the Chinese, I'd be looking to swap treasuries for gold because they've been big buyers of gold over the last 5, 6, 7, 8, 9, 10 years. They've built up their gold holdings as much as they've built up their dollar holdings, and they have, I believe, about 3.2 or 3.3 trillion in dollars. So let's get creative because somebody else is going to get creative, and it's Pozar raises that issue of things that the People's Bank of China can do. But if you need, to start shifting assets around, he's talking about raising dollars. Yeah, maybe raising dollars, but you don't have to because if somebody says, the Chinese are actually in a pretty good position because they, they have a futures, they have an oil contract. You know that, right?
Right.
In Shanghai, and you know how it's priced, right?
In yuan.
In yuan. Somebody had an article today in the FT. It was interesting. And I said, okay, here's somebody's thinking. Because if I'm the Chinese, I'm promoting my oil yuan. I'll buy oil. They buy, 10 million barrels a day. But I'm going to pay you in yuan. You wanted it? Yes or no? Now the world now we're going to get to interesting times. And these are the times when you're going to really have to look and know the fundamentals if you're trading for more than 1 second. And I believe we will do in this room, we will really be on top of this and coming up with some interesting ideas. Because listen, this is what, you know, I sit and analyze. And again, I always eat my cooking. I don't just spew stuff out. I'm thinking about these things and wondering always aloud. And when I start to see the flows support the view, you know, that's when I get in. I don't ever try to get in at the bottom or at the top of anything, because as my dear mentor Lenny taught me, there's only one top and one bottom to any market. Pick it.
Yeah. So Ira, I got two other things here. One, the spies are going to try to get their ORH daily stops. And Anne-Marie just sent me a note that I dropped the question into your box.
Oh, hold on.
It says, do you think the commercial paper funding window will help us put in a bottom?
I would say yes for the day, you know, for a short term, because that's going to free up, you know, that's where the system is clogged. Hold on, let me, Anne-Marie always asks great questions. I tried to contact her the other day on LinkedIn. It said we were connected.
She was in that trader show in New York.
Oh, okay. Yeah, and I saw, what's her name too, who I like, Shy Girl, who puts out some good stuff too. Hi, Judd, do you think commercial paper funding window will help us put it in the bottom? I do. And you know what? For today, yeah, that was a pretty good thing. And yeah, I got something from Alexandra this morning that the Reuters, not Bloomberg, was reporting that the Fed is set to reset the commercial paper facility today. So they'd be buying a lot of stuff, which will take the pressure off some of these money funds, you know, because it's the funds who have a tendency to be in the commercial paper market. And when people start to get nervous, well, you've seen it. If you saw LIBOR today, if you've watched the FRA-OIS spread, it's been bouncing all over the place. Yesterday, it corrected a little bit with everything they did over the weekend. But the Fed is really going to have to be on their game. And yes, I think that's right. I think Anne-Marie is usually, you know, point on target, and it's having that effect because, you know, okay, that takes some of the funding pressure off. Because right now, people are just scared about credits. You know, as I always tell you, it always comes down to debt. But the other side of that is, you know, who's a good credit, and it's tough to figure it out. It's tough to figure it out. You know, you look at some of the regional banks, which have been some of my favorites, and I'm left with one rump position. You know, shame on me, because I did really well in it. And it's the regional banks have just collapsed. But that is the regional banks collapsing. And if you start to see the demand shock that we've discussed, when others, you know, were quick to slough it off, I have not backed off from it. You know, even with Bookvar and Jimmy Bianco, when in our discussions, David Rosenberg's another story, but Bianco and I, and they got it. And if the fear of the demand shock begins to lessen, the regional banks ought to be a really good place to invest, because that's what they're struggling with right now. Just like Pax talked about those farmers. Well, who do you think's lending to those farmers? Who's lending to those cattlemen? It's the regional banks. And if the fears are there, it used to be the community banks, but so many of those have disappeared that they're more regional. If those start to rise, then some of the pressures or some of the perceived threats from a demand shock are starting to ease off. I think that'll be the tell more in the regional banks than it will anywhere else.
Well, and the regional banks have a long way for a dead cat rebound.
Well, yes, you know, but the politics of this, if these knuckleheads, and I use the term in its full meaning, in Congress and in the Senate, don't wake up that, hey, you can't do everything, you know, they have to take the Fed to task. You can't just do everything for the Wall Street institutions. You better get out ahead of what these regional banks need. You know what? There's an election coming November, and you don't want those areas of the economy being under more stress than they are, because there is no chance that this administration will hold the White House. If this really bleeds into severe economic stress in those states, again, part of that is the problem with the oil. Because Texas, don't forget that Beto, what's his name? The guy who was running for president who backed out, but who ran against
Beto O'Rourke.
He only lost to Ted Cruz by a little. So if Texas has been riding a great prosperity wave, but if that energy sector turns down because of the actions of the Russians and the Saudis, which they are fully aware of, by the way. I don't know, the Saudis, yes, but the Russians definitely. If Texas goes Democratic, it's over. And don't forget, Cruz his margin of victory was not that great. Now, yes, he's is he more despicable than anybody else? I don't know, but he certainly had his problems. That gets into the mix here. So things to pay attention to, but watch the regional banks because they've really gotten hit hard here. I mean, they've all been hit, but they've been hit, and that's the sense of the demand shock on a nationwide basis. Anything else we're going to figure it out? You got one more? I'll give you one more, and that's it. But we've put a lot of stuff out there on our plates, and that's why I went to look at the gold yuan. Hello?
Yeah, we're here.
Yeah. That's why after I read the Pozar piece, actually, that was written March 3rd, which I did, the gold yuan really jumped up because I go, the Chinese, again, this is a good time. If you're looking to cause some disruption in the system, if you feel confident enough that you could bear up, and you go, there's a lot of havoc you can wreak in the global financial system, like with a tweak here and a tweak there. And again, I stress to people, the Russians especially like to be disruptive when people are looking elsewhere. And now they're all consumed with with COVID-19. That's looking elsewhere, and that's Putin's really great history. Is that again? When does he invade Georgia? During the Beijing Olympics. When does he seize Crimea? During the Sochi Winter Olympics. When there are things wrong, or when the world's attention is elsewhere, I should put it that way, he likes to stir the pot up. And so we got to leave you with a few things. Keep your eyes on the European debt markets. We see the movements there. The French, the German, everything is widened out dramatically in Europe against the Germans. But if Merkel capitulates on fiscal stimulus, which I believe she is, because we haven't even gotten to the Lagarde stuff. We'll do that next time because that's a big piece of my thinking right here. I think she's been brilliant, and I've never been a Lagarde fan, but I thought the hand she played last week was really, really good. Others say no, she made major mistakes. We'll see, but that's what makes a market. If there's any other pressing questions?
Ira, this is a kind of an off-the-wall question. This is Jeff from New Jersey. Supply chains with all these travel bans, and the biggest thing that I'm concerned about is like the transportation of drugs or materials that are needed. Any thoughts and ideas on that?
No, I saw what Amazon did. They're shipping medical. They're on a priority basis now. So I think that's what you're talking about, Jeff. I think certain firms, there's Medline out of Chicago and other places. So these are huge institutions. They will ship. And again, I know that Trump talked about that yesterday, is that they will mandate to get the supplies where they're needed. It's not that we have a shortage of them yet. There's again, the capacity of transporting them that is of the utmost significance. But I can't, outside of that, I really, you know, I don't know. People are, the one thing, and I agree with Kramer about that, Americans are really resilient and creative when it comes to doing things. So, and it's not that I'm Pollyannish, I'm not, but I think that somebody will figure this out, and I'm not really worried about those shortages. They will get them to where there's needed. They have to. All of a sudden, you know, Trump's going into war mode in the way that he's dealing with it. So believe me, if they run convoys with troops, it wouldn't surprise me. So I really, unless there's truly just a lack of supply, which I think that you're starting to see certain, like Clorox and, you know, people with antiseptics. It's interesting that I guess some alcohol manufacturers are using some of their raw alcohol to create cleansing solutions. So, you know, again, where there's a profit, thank God, people will find some incentive. Does that answer your question?
Right. I'm thinking at a much higher level, not the cleansing stuff, but antibiotics, specialty drugs, that type of stuff.
Well, but right now we don't know what drugs it is. You know, they're in testing mode, so we don't know. So how do we know what we're going to have a shortage of if we don't know what really affects us? But as my brother says to me, he says, you know, the way this spreads, you know, it's sneezing or coughing, and he says it's a very fragile germ, meaning that it dies. You know, that's what they believe right now. That's the latest. So it dies fairly easily. Yes, it spreads, but it's not robust. You know, there are those that are robust, and I think SARS was robust. I think the bird flu was very robust. This virus doesn't seem to be nearly as robust. So that's a good thing. Doesn't mean that you know, people don't do the right things, it can't spread, but it seems to die, but they don't know how to treat it, so we don't know what we're going to have a shortage of. Certain people who are under certain types of stresses because, you know, they're elderly, or they have diabetes, or they have a heart condition, or all types of, you know, problems. Yes, but their medications are going to be, you know, we don't know. We can't define that. It's not a general thing, but we don't know anything that treats this stuff yet. Nothing that has an effect. You know, they're still experimenting, and they're in war mode, experimenting in a very aggressive way. But we still do not know the answer to that.
Just one more kind of like follow-up or the angle that I'm taking this from is I'm not necessarily talking about the virus. You brought up diabetes. So as in insulin, as in, like, I have a relative who has a particular case where they need a particular specialty drug that is only made just outside of Paris, you know, and it doesn't have a long life shelf. Now, as in transportation, production of those types of items and that have nothing to do with this disease, just the common medical issues that we face every day.
No, yeah, and so far those haven't shown up yet. So you know what, Jeff, it's always a possibility, I imagine. I'm not qualified to answer that question. I'm sure it's a possibility, especially you know, with people being homebound, and but I would hope, and I saw what Amazon said today. So they're shipping drugs and things that are needed. That's their priority. So let's hope. And whether there's enough supply, I'm not equipped to answer that.
Look in your chat box.
Look at my chat box. Okay, so we'll do. Hold on. Blah, blah, blah. Okay, Treasury Ministry, referrals, 300 million in payments to the IRS. Nugent said they can defer up to $1 million. Okay, that's probably more responsible for the reality, because again, that'll provide, you know, short-term liquidity into the system, because anytime you relinquish that. But I'll tell you one other thing that I'd be watching for here with the banks. Let's see if the FDIC ramps up deposit insurance so that accounts, you know, go up to that you're fully insured up to $2.5 million. Okay.
Yeah, good point.
Let's see if those things start to come about, because if you see a spike again in the FRAOIS, they're going to get, then, you know, it's signaling stress in the banking system. That's what that signals. So we haven't heard from the FDIC. Boy, I wish Sheila Bair was back in control there, because I had a lot of respect for Sheila. And I won't talk about her Lizzie Warren letter. And that's her politics, and that's fine. But as somebody who really understands banking and the needs, she was really good. But let's see. We haven't heard from the FDIC, but it wouldn't surprise me to see something of that nature, just to ensure that the banks don't have any types of runs. So that's what I'll leave you with. And maybe tomorrow, let's see what goes on in the markets. But again, this format is going to tighten up, and we're going to get really question bound. Okay?
Okay.
Yes, beautiful.
It makes it easier for me, and and if I can't speak to it, I won't speak to it. But we do these questions to ferret out the best trades possible facing us.
All right.
Okay. Thanks.
Ira.
All right.
Thank you,
Okay,
Ira.
guys.
Thank you.
Okay. Anne-Marie, thank you. Bye.
Okay, guys. So, well, that was a big rip your face off rally. You know, you got to really look at these half-day bars when I put them up, when they're going for these stop runs. And keep trading the market in front of you. There's another 50 handle break in SPU bonds. Oops, hold on.